90% of the VC-backed tech industry. Like, if you're that smart, why aren't you out there trying to save the planet? We were looking at acquiring 3 businesses concurrently, and we ended up buying all 3 companies. I would call it the operational diligence and the financial diligence of that process. One of the big lessons for me was that despite people's best efforts, diligence only goes so far. A lot of it's really difficult to validate, right? So a lot of diligence, I think, is asking the same question like 6 different times and trying to catch people in a lie, because otherwise there's almost no way, especially when you can't talk to the employees. I think in venture, we want to make decisions based on really, really accurate financial analysis of the risks that we carry. This feels bad, even though it looks good. Moment bad, we're like, no, that's when you do bad deals. We're too small to do bad transactions, and we have to trust our gut.
Welcome to the latest episode of High Stakes. I'm Paige Soya, managing partner of K Street Capital, and today we have with us Dimitry, the CEO, founder of Enduring Planet, one of our portfolio companies that we're very excited about. It's one of our fund investments, and before we start talking about exits, this is going to be a little bit different of an episode, but before we start talking about the main topic, Dimitry, why don't you introduce yourself?
Sure. Thanks so much for having me. So I'm co-founder and CEO of Enduring Planet. We provide working capital and financial advisory services to climate companies. So we work in probably the largest and fastest growing sector maybe ever. I think climate is, especially today, it's very relevant given what's going on in Florida, but we're dealing with sort of an unprecedented challenge in the history of humanity, and much of the global economy will need to adapt. And that's a fun problem to be working on, because financing and sort of making sure that the problem is well capitalized is it's a challenge that kind of goes beyond even the scope of most people's understanding. So it's a problem I've been working on now for 15 years, and as an operator, as a in big corporate, as an investor, as a board member, I've kind of seen a lot of the different parts of the ecosystem. In terms of like relevant to this conversation, talking about exits, I did spend a little time in the kind of holdco PE, like M&A units. We actually spun Enduring Planet out of a holdco that had a venture studio, where I was an operating partner, and I navigated 3 acquisitions while I was there into a portfolio of infrastructure businesses. So I got to see effectively 3 exits happen, and I then handled the like roll up and integration of those 3 companies. And so lots of fun learnings there.
So let's dig into that for a second, because I know you since Enduring Planet, and obviously I know your background, but I don't know all the details of it. But so you were really on the investor side of the table, and these were portfolio companies that were exiting. And were you sort of like the operating partner in those, sort of like for the deal on behalf of the investor? Is that?
So yeah, maybe just to clarify, right? So the way the Enduring Ventures platform works is that they acquire small, medium-sized businesses into portfolios that then have an integrated set of operations, right? So at the time, they had a tech portfolio. I was leading the like rural internet infrastructure portfolio. There was then a construction and HVAC portfolio. There's like lots of these little pockets. And when I joined right as they were starting to build the rural internet infrastructure portfolio. And we were looking at acquiring 3 businesses concurrently into what is now Rango Wireless, like a wireless.
So a big roll up.
Yeah, a big roll up. And we ended up buying all 3 companies. And I led the like kind of, I would call it the operational diligence and the financial diligence of that process. We had consultants doing technical diligence. We had some accounting firms doing, quality of earnings analysis, et cetera. And my job was to kind of put it all together, put recommendations forward about not only the acquisition itself, but also like what happens after, what will be required to kind of integrate these 3 businesses. And then I stepped in as the like COO of the company for about a year. And then we brought in like a seasoned telecom executive to run the business. And he had a team that he brought in as well. And then I transitioned out. So that was kind of always the intent.
Tell me about it.
Well,
Tell me about it.
I think that
I was just talking to someone about this. It's pretty difficult to put a plan together for how 3 separate companies are going to integrate together and work together. You can make all the plans you want, but it's going to be a whole different ballgame when you actually get there.
I also think that oftentimes it's way easier said than done when it comes to integrating businesses that historically have operated like a very localized, in-person, small business with local management, local ownership. And it's very doable. But I think oftentimes the like people dynamics, the cultural dynamics, the operational challenges of each business do not lend themselves well to the speed of integration that one would want. And that was one of the like biggest lessons, was that in many ways, the speed at which I wanted to move to unify these businesses was way too fast compared to like, in some of these cases, this is like a 20-year company with employees who have been there for like, I don't know, a decade and change. And they're like, who is this guy? And in this case, like, it was also particularly interesting because, and I use the term interesting liberally here. It was fun because we bought these three companies in July of 2020.
Okay.
And which was a challenging time. Three businesses, no one had ever worked remotely or had to deal with any remote colleagues. And they were all local, right? Like nobody had ever done Zoom calls with leadership before. Like these were all just like really foreign concepts. And
But
so,
you're saying in 2022 though?
no, in 2020.
Oh, okay, in 2020. Got it.
20, right? And, like most businesses in this country have never had to do a Zoom call, even today, right? And so like when you buy three of these and all of a sudden there's like some guy in Oregon and, these were like in Nevada and Washington, some guy in Oregon is like, hey, I'm your boss now and I'm going to talk to you every couple of days over video and like tell you stuff. It's like in retrospect kind of ridiculous. And we made it work. And I think, one of the things that was really helpful was that we focused really hard on putting forth a cultural model and a set of values that I think most people could align around, right?
Were you doing that before the deal was done, or was that like a post-deal exercise?
Most cases when you do acquisitions like this, the employees have no idea that it's happening. And so you kind of show up all of a sudden.
Yep.
And the owner is like, hey, I didn't tell you guys because I wasn't sure if it was going to happen until the paperwork was signed. But hey, I sold the business and now I'm not the boss anymore, or I'm on a 12-month transition plan, right? And the one thing that helped is that when we came in, we said, look, like everybody who works here has all of the institutional knowledge. And you're incredibly important to the success of this business. And this isn't like a private equity play where we're just going to fire everybody and cut costs, right? What we want is to build really enduring, long-term, successful revenue. And so, on the other hand, like it became pretty clear over, the first few months, like, hey, in some of these cases, like nobody has ever actively managed you. Nobody's ever set clear expectations. Nobody's ever given you feedback. Like some people had never gotten a performance review or any kind of performance anything in years, right? And so trying to establish those systems while maintaining trust and like helping people feel valued was pretty like insane task and worked, and some of it did not.
Yeah, I think that's often the hardest part about transactions. It's not the number crunching piece of it usually. I mean, it's the people stuff that comes after.
Yep.
So I guess, but that being said, was there anything else that came out besides that? Like you were going through diligence, and were your expectations the way that aside from the people stuff, were they kind of in line with what you were thinking they would be in terms of the real performance of the company financially? And you mentioned they're small companies, so I imagine they're not audited, maybe imperfect information. And
so I mean, cumulatively, the three businesses were doing. I'm trying to figure out what I can actually say, right? So I'm going to put it in a range. They were doing between like $5 and $10 million in revenue, combined revenue, profitable, 50 employees across 3 states. So they're pretty serious business, right? One of the big lessons for me was that despite people's best efforts, diligence only goes so far.
Yep.
A lot of it is Yeah, a lot of it's really difficult to validate, right? So a lot of diligence, I think, is asking the same question like 6 different times and trying to catch people in a lie
Yep.
because otherwise there's almost no way, especially when you can't talk to the employees, right?
Right.
So like what do you have? You have finance, you have contracts, you have maybe like a view into their billing or CRM or whatever, which a lot of people don't want to give you when you're doing underwriting
Right.
because it has sensitive customer information and like who are you to get access? There's like all of these limitations, right? And you kind of have to work around the limitations. And I think that uh, to say about like instinct matters a lot in these transactions and sucks because sometimes you're looking at diligence materials and you're like, all of this feels right. I mean, all of this on paper seems right, but it
Yep.
feels wrong. You kind of have to trust that feeling. And we've even had this experience at Enduring Planet, right? So we actually in our this is not an exit thing, but I think it's relevant. We had a deal now like 2 years ago that was impeccable on paper, like so impeccable. We moved through it so fast. They had a loan from another company. We're a lender, right? So they had a loan from another company we knew that we really respected. Everything about it was perfect. It had the fastest approval process in our IC ever. Like we sent it out and like within hours, all three IC members were like, this is like the best
Yes.
deal you guys have
Do
done.
it.
But it felt a little weird. And instead of just doing it, we were like, we're too small to do bad transactions and we have to trust our gut. And we dug in and it turned out to be one of the most elaborate financial fraud
You're kidding.
efforts that has been perpetrated on fintech lenders in the US. Pretty much half of our peers got scammed out of like 100 to 150K checks. These people actually had like 15 or 20 fake subsidiaries that transacted between themselves to create a financial trail in banks that
Wow.
when you looked at it, you were like, oh, there's bank data. It matches accounting data. There's customers. They had customers that they had set up who would take reference calls.
Yep.
Like
Oh wow.
it was
Oh wow.
so
That's elaborate. That's so elaborate.
so elaborate. And so we caught it before we funded, which is like one of our proudest moments. And again, like half our peers, I'm not going to name who, did not, who manage hundreds of millions of dollars, right?
So wow. Wait. So I know this is off topic, but what happened? What's the end of that story?
So
When you caught it, do you go? Do you? What do you do?
we caught it. We reported it to the FBI.
Okay, got it.
It didn't really go anywhere. We did report it to our friends who we knew did the deal.
Okay.
One of them actually got their money back, which is crazy because generally once you wire somebody money, you can't get it back.
Yep.
But they like went to war with the bank, who they were like, you're culpable for not doing your KYC. We
Interesting.
want our money back. And the bank actually reimbursed the wire, even though the money wasn't no longer in their account.
Wow.
And yeah, so it was like this huge, it was really crazy. And we were like probably a day away from funding.
But I think that's so important because there is this part of doing a transaction, whether it's financing or M&A. It's the same sort of gut feeling that's part of it that doesn't get talked about a lot. And do you know what it was in the end? What that gave you that feeling, or is there a way you could describe that?
Yeah, so some of it in retrospect, I'm like, oh duh. So one of the things that we had was that whenever we spoke with the prospective borrower, they never had their video on for calls. We're always like reasons, like, oh, I'm in a car or whatever. And now it's like a firm requirement for our underwriting, like we need to see people, right? Two is that they almost too fast responding to stuff, like very, very canned, very, very fast. And then in certain areas, there was pushback where, like, especially at the end when we were like, oh, we feel a little funky, like, hey, can we do reference calls with customers? And they were like, well, none of the other lenders asked us for reference calls.
Really?
Yeah. Another thing that kind of threw us off was that the company was in the US, but like what calls they were on, like the time zones were a little weird,
Oh, I see.
And it kind of became clear that like they
Was it a foreign? It was a
yeah,
foreign.
yeah, it's like a South
between-
African, like
Got it.
basically, I don't know if it's like mob or whatever. It was very elaborate. It took years of planning. I mean, they had like fake bank transactions between customers, supposed customers that ran at least 18 months. So what they did was they actually figured out how fintech lenders underwrite and how to get all of the data to line up so they can get a loan in the bottom bracket that doesn't trigger additional review. And so it was like very, very smart, like so smart, you know?
Blows my mind because I'm like, if you're that smart, why don't you just do something meaningful for the world instead of doing this? You know?
And yeah, you know, that's a different
topic. Yeah.
I would ask that question of pretty much, you know, 90% of the VC-backed tech industry. Like, if you're that smart, why aren't you out there trying to save the planet or, you know, whatever, cure cancer?
Yeah. Wow. Yeah. I mean, because I will say as an investor, we get that feeling sometimes too. And it's really hard because I think, and sometimes it's the other direction too, right? Like sometimes it's like, oh, our thesis is this and we don't invest in companies with less traction than this and blah, 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 blah. You don't meet our criteria, but we really like the company for one reason or another. And making that decision is it's very challenging, you know, but I do, in my experience, it has always paid off every time. So, you know, and earlier in my career when I wouldn't pay attention to it because I would say, you know, it's discrimination. Maybe I don't like the company because it's a young founder or an old founder, or it's, you know, whatever the reason is that's impacting my feeling bad about not wanting to do this, but it must be that. So I'm going to ignore my gut feeling and I'm just going to make the investment because it does meet the criteria. And I don't know why we wouldn't. Every time I did that, I should have not.
There's this good check. We actually do this a lot when we hire too, where anytime somebody's like, I got a bad vibe about this, you ask the follow-on question, like, is this bias? Really interrogate and like have somebody help you interrogate if this is bias, right? Like, would you have said the same thing about whatever, right? And I think your point about like, well, what gave you the bad feeling, right? You can often like drill down and then you'll come at like some answer to some question or some activity or some micro movement or whatever where you're like, oh, you know, I caught them like being squirrely about this question. Like, and then you can follow up, right? You can be like, hey, we noticed this thing. Why did this happen? And sometimes it's innocent, right? Like sometimes you're doing diligence on someone and they're like cagey about something, or they don't answer a question all the way, or they actually answer it in a weird way. And then you follow up with them and you're like, why did you do this? And they'll say, well, we had this experience with another investor where the same thing led to a real problem. And so now I'm like, I have trauma, you know?
Yeah. Yep.
In which case, like, cool, actually, I really respect that, you know?
Right. Yeah, that's a great idea. I mean, we should probably do that. We do have our own sort of checking of like when we first meet with the founder, you know, obviously the founder is everything at this stage in our business. It's probably the single most important factor. But we do the diligence anyway, obviously. And through the diligence, we're actually really trying to get to know the founder and the way they answer the questions and how trustworthy they are and what kind of character they have and how responsive are they and, you know, how respectful are they, all those things. But in the very first meeting, we always talk about afterwards, you know, like scale of 1 to 10, what was your vibe on this? Like 10 being best friend forever, like somebody I would really like hang my hat on, you know, and 1 being criminal. I don't know.
Yeah.
And it's just a gut thing which we don't necessarily use. Again, I don't know if it's really even useful because we talk about it and we decide if we want to move forward or not and why. But I like this. I like this sort of bias thing. If that's a well thought out process that you can share, or like a questionnaire, or what you do, I think that would be super helpful to people for their own decision making.
Okay, maybe I'll put something together. Yeah,
I mean, I think free time.
It also depends on the asset class, right? Like, I think in venture, that feeling is so much more important than in credit. And in credit, we actually want to eliminate that feeling as much as possible. We want to make decisions based on really, really accurate financial analysis of the risks that we care about, right? And sometimes, like, the only time really when we listen to instinct is in that, like, this feels bad even though it looks good moment. We never use it when it's like, this feels good even though the numbers look bad. We're like, no, that's when you do bad deals, right? Like, because in my job, I want to give everybody money, right? And there's
Of course.
actually like, I'm not in the credit process at all in our business, and neither is my sales team. We don't touch it at all. We never push for a deal to close because like the underwriters need to feel comfortable,
Of course. They need to
and
make
our,
that
our
decision.
vibes don't matter, you know?
Right. Right. Well, cool. Well, any other final thoughts? I know we're coming up on time here. This has been a super interesting episode, and I think people are going to really enjoy it because these are topics that don't get brought up that often. But any other final thoughts or, I don't know, takeaways from the exits and the roll-ups that you've been involved in?
I mean, I think that the thing that really kind of stuck with me throughout all of that process was that oftentimes both sides will have ideas about what it takes to make a transaction work, right? Especially around like pricing and structure. And in reality, there's way more flexibility on both sides. People will get really stuck on like the number, you know? I think what often matters more is both sides' ability to sort of structure how the payouts happen so that everybody's happy, right? So one example is like, especially in small business acquisition space, a tool that is not used as much as I think it should be is seller finance, right? So like people will borrow money from a bank to buy a business, they'll put up a bunch of equity, but oftentimes sellers are like, wait, you'll pay me for the next 5 years with interest for half of this, and I like get to make a recurring income. I pay tax on it differently. Like there's all of these levers, right?
Oh,
And
yeah.
so I think also in the startup universe, I think way more opportunities for startups to acquire small businesses that are like tactically relevant to their thing. And there's always this like consternation. It was like, whoa, but it's not software. It's not scalable. Like I often think that those small businesses can add a lot of a strategic value that goes beyond the like revenue potential of that small business. And you see that with Carta, you see it with SoFi, you see it with like a lot of the really successful big platforms. They've actually bought a ton of like consulting businesses, services businesses, little data businesses. They're not billion-dollar opportunities. And oftentimes in those cases, if you're a startup that has a billion-dollar outcome on its horizon, your equity is worth way more in the long term. And so like there's actually a lot, even more creative stuff you can do around acquiring small businesses. And so I think for everybody listening, like if you're on either side, like I think there's more opportunity for that type of collaboration that people just aren't pursuing.
Yeah, I think you're right. It's like this level of flexibility that just doesn't seem to exist in a lot of these transactions that if it was there, everybody could everybody could win. It could be a better transaction for everybody. So
I mean, people just need to talk to each other and say, like, what do you really want, right? Like, is it that you want $1 million today, or do you want 1.25 over the next 3 years and you don't really care how you get it? You know?
Exactly. It's so true. It's also, do you want to keep running the business? Do you want to, do you believe that the equity in the buyer's business is going to be more valuable than your equity? Do you want to take part of it in equity? Do you want to take it all in cash? Like what are the motivations? And
yeah. And a lot of those levers trade off of each other, right? So it's like, there's not one answer. There's like 500 answers, and there are all these like little adjustments that you can make that make everybody happy.
That's why I love this podcast, because all the episodes have different little pictures of each of those 500 things and how they play out in the end.
Totally.
So anyway, I know you've got to go. Thank you so much for doing
Thanks
this.
for having
This
me.
has been amazing. And
Ditto.
that's a wrap.